Welcome to this explainer. Today, we're diving straight into the core quantitative building blocks of finance. If you've ever dug into those first few foundational readings on rates, returns, and statistical risk measures, you know it can feel, well, a bit like a whirlwind of Greek letters and massive equations. But we're going to break all of that down. We're taking those abstract formulas and turning them into a highly practical analyst's toolkit. So let's get into the exact mechanisms professionals use to value assets and truly understand risk. But right before we jump in, ask yourself this one central question. How do you actually measure a return? I mean, raw numbers, they're kind of meaningless without context. When you see a 5% return on a mutual fund or a 3% interest rate on a loan, those digits are literally just scratching the surface. An interest rate isn't just a number, it's a story about opportunity cost and risk. By the end of this explainer, you're going to have the specific quantitative lenses you need to read that story clearly, separating the background noise from the actual financial reality. Here is our roadmap for today. We'll start with measuring rates and returns, then move to the time value of money, dive into statistical measures of returns, and finally, we'll wrap up by sharpening your overall analytical edge. All right, let's kick things off with our first tool, establishing a solid baseline for measuring rates and returns. Now, when you're looking at performance, you really have to stop and ask, whose performance are we actually evaluating here? This brings us to a classic stumbling block: time-weighted returns versus money-weighted returns. If you are evaluating a fund manager, you absolutely have to use the time-weighted return. Why? Well, time-weighted returns strip out the effective cash flows. Think about it. A manager literally cannot control when an impatient investor yanks their cash during a market dip or when they suddenly dump a massive sum right at the absolute market peak. The manager shouldn't be penalized or rewarded for someone else's timing. On the flip side, the money-weighted rate of return, which is basically just an internal rate of return, accounts for the exact timing of an investor's deposits and withdrawals. So that one is the true measure of how the investor themselves performed. Of course, we also have to adjust those returns for the actual reality of the economy, right? To find the real return, the one that actually increases your purchasing power, you've got to strip out the inflation premium from the nominal rate. The math is pretty elegant. You take 1 plus the real risk-free rate, multiply it by 1 plus the risk premium, and then divide that entire top section by 1 plus the inflation premium. A nominal return might look absolutely fantastic on paper, but if inflation is eating away at the currency at the exact same rate, your real return is zero. You haven't actually gained any real purchasing power at all. Another absolutely crucial point here is understanding the vocabulary around fees. Gross return is the total return on a security portfolio before you deduct the fees for the management and administration of the account. Net return is simply what you're left with after those specific management fees are taken out. But here's the trick that constantly catches people out. Both of these measures deduct trading commissions and the other direct costs needed to generate the returns in the first place. The strict, literal differentiator between gross and net is purely those management and administration fees. So always double-check if you're looking at a gross or net figure before you make any allocation decisions. Moving right along, let's shift our perspective a bit and talk about the time value of money. So, what actually is an interest rate in the context of time? It's really essential to get that interest rates aren't just arbitrary numbers pulled from thin air. They actually represent required rates of return, discount rates, or the opportunity cost of what you could be doing with your money right this very second. Say an interest rate is 5%. That's your required rate of return for parting with your cash today. It's also the discount rate you'd use to mathematically shrink future cash flows back to their present value. And honestly, perhaps most importantly, it's the opportunity cost of current consumption. Choosing to spend your money on something flashy today literally means forfeiting that 5% growth for tomorrow. Now, this gets incredibly interesting when we look at how the math of compounding plays with that time value. As you bump up the compounding frequency, going from annual to semi-annual to monthly to daily, the present value of a future sum goes down. Or if you flip that around, the future value of a present sum goes up. But it doesn't just increase to infinity, right? It actually approaches a mathematical ceiling, a limit of continuous compounding. Notice the elegance of the continuously compounded return formula. It's simply the natural log, or ln, of the ending value divided by the beginning value. Because it's perfectly additive over multiple periods, it is an absolute favorite tool for advanced financial modeling. Okay, with returns and time value under our belts, let's step back and look at statistical measures of returns so we can analyze the actual shape of risk. When we analyze a data set of historical returns, we don't just stare at a wall of numbers hoping for a revelation. We use a really logical three-step progression to break the data down. First, we find the middle. We calculate central tendency using tools like the mean or median to find the expected average. Second, we measure the spread. We calculate dispersion using variance or standard deviation to see just how far the actual returns tend to wander away from that expected middle. And finally, we analyze the extremes by looking at the shape of the distribution using skewness and kurtosis. Because let's face it, a high return means absolutely nothing if the variance is wildly unpredictable and the shape implies a massive catastrophic downside risk. Let's zoom in on one very specific measure of that central tendency, the harmonic mean. This calculation is a huge deal when you're practicing cost averaging, making periodic fixed money purchases of something like mutual fund shares. As a mathematical rule, the harmonic mean is always less than the geometric mean, which in turn is less than the arithmetic mean. Think about it like this. If you're putting $500 a month into a fund, no matter what the market is doing, you're automatically buying more shares when prices are cheap and fewer when they're expensive. The denominator in the harmonic mean formula handles those negative returns beautifully, giving you the true, highly accurate average share cost over all those periods. So once we know the middle and the spread, we really have to talk about those extremes. Visualizing kurtosis with the physical analogy of fat tails makes leptokurtic distributions instantly clear. It means extreme, outlier outcomes are way more probable than they'd be in a normal distribution. A standard, perfectly normal bell curve has a kurtosis of exactly 3. But real-world financial markets, they often have positive excess kurtosis, meaning they are leptokurtic. They have a sharper peak, so lots of small everyday deviations, but crucially, they have fat tails. Those fat tails are the severe market crashes or the explosive rallies that happen way more frequently than a textbook bell curve would ever predict. Honestly, if you aren't measuring kurtosis, you're essentially flying blind to the real probability of a black swan event hitting your portfolio. All right, let's bring it all together now in our final section, sharpening your analytical edge. To wrap up this explainer, remember that a truly successful analyst doesn't use any of these tools in isolation. It's all about seamlessly combining rates, time value, and statistical variance to critically evaluate investments. You need rates and returns to ensure you're adjusting for inflation and using time-weighted math to judge managers fairly. You need the time value of money to discount future cash flows back to today using continuous compounding. And you absolutely need statistical measures to map out the exact dispersion and kurtosis of your historical data so those fat tails don't catch you off guard. Bring all that together, and you've got yourself a pretty impenetrable analytical framework. We're going to end on this thought for you to ponder. You have the tools, but are you actually measuring the right risks? A spreadsheet can spit out a geometric mean or calculate a continuously compounded return flawlessly in milliseconds, but it's up to the analyst, it's up to you, to look at that output and ask, am I actually using the correct measure of return for this specific scenario? Have I accounted for the fat tails in this asset class? The math gives you the numbers for sure, but your analytical edge, that gives you the wisdom to actually use them.